eSwatini's economy risk crashing. The Kingdom of Eswatini is carving a path to a private-led economy, an economy at risk of crashing if it does not embrace crucial economic reforms. For a while now, the kingdom has been struggling to attract investment, but the COVID-19 pandemic seemed to have presented the opportunity it needs to restructure the local economy. That's why late last year, Eswatini unveiled an economic recovery plan to get it out of the woods. The Kingdom of Eswatini is expecting big things from its ambitious post-COVID-19 economic recovery plan. Managers of this small landlord monarchy in South Africa are hopeful that the plan will jolt the economy into a much stronger one after the pandemic, compared to its neighbors in the region. The post-COVID-19 economic recovery plan released by officials detailed its focus on 8 sectors of the Eswatini economy, amongst which business, agriculture, tourism and environment, mining, and also energy and water. But 8 months after the recovery plan was drafted, Eswatini's economy has yet to feel the effects of the stimulus. Before COVID-19 hit Eswatini, the government was already experiencing cash flow setbacks. The virus only battered a long existing and fragile fiscal issue. Slowdown in economic activities has meant revenue loss, creating an even bigger fiscal deficit. Economic managers fear that without any significant reforms and adjustments in government spending, the economy will experience a severe crash. The country's Minister of Commerce, Industry and Trade, Senator Mangoba Kumalo, tells business in Africa that we've created a list of projects that are basically implementation ready, and that with government enablement and with a clear view of the value that they are going to bring in terms of creating revenues for corporate taxes, revenues in payroll taxes, revenues in consumer taxes. There you have it, guys. That was the latest business news in the small country based in South Africa, Eswatini. Hope you did enjoy that video, and if you did, give us a thumbs up, and also do not forget to click on the subscribe button and also click on the notification bell so that each time we upload a new video, you'll be the first to know. Thank you so much for watching, and I'll see you in my next video. Bye bye. Africa's private equity industry in serious stress. Africa's private equity industry has been partly shielded by the impact of COVID-19 due to the continent's relative lack of cases, the dominance of development finance institutions, and its prior exposure to crisis. But partners fear that the pandemic impacts on exits, according to a report. The COVID-19 response report by the Oxford Business Group and the African Private Equity and Venture Capital Association found that the Africa-focused industry raised $1.1 billion in funds and arranged 81 private equity deals totaling $700 million in the first half of the year, with financials, IT, and consumer discretionary accounting for 49% of deals by volume. The pandemic sparked renewed interest in education and healthcare. The latter accounted for the largest share of deals by value at 24%. The AVCA says that the prominent role of development finance institutions, DFIs, in Africa's private equity industry offered resilience, with some DFIs introducing strategies to shield their investments from the pandemic, and most investments already armed with strict environmental, social, and governance criteria. Other DFIs have pooled their expertise into working groups to respond to the crisis. Furthermore, the AVCA says that African fund managers were better able to provide support and enable continuity at portfolio companies, having already dealt with challenges in Africa, including shorter supply chains, more debts, and less inventory. This built-in preparedness ensured that many portfolio companies were able to absorb some of the initial shocks in global supply chain and local demand, says the report. Nevertheless, the pandemic has exposed some of the African private equity industry's inherent weaknesses. Weak exit environments, political risk, and currency fluctuations have all been exacerbated by the pandemic, and African governments are unlikely to offer financial assistance to distressed companies. The uncertainty has led fund managers in sub-Saharan Africa to close their funds at smaller sizes during the pandemic, with some anticipating an reduction in capital inflows, particularly from European commercial investors and Asian institutional investors. An AVCA survey in April found that 49% of respondents expected a 6 to 12 months delay in capital deployment. Over 90% of respondents listed the financial impact of the pandemic as their top concern, with over half concerned by a potential global recession and around 45% fearing a dip in consumer confidence that has impacted confidence around exits, with 57% saying that exit opportunities were the greatest challenge in Africa in the small or medium term. 13 exits were recorded in the first half of 2020 compared to 25 in the first half of 2019 and 45 for the year. Exits are further complicated by travel restrictions, which are impeding the ability of investors to carry out due diligence, says AVCA. Nevertheless, several high-profile exits have been concluded this year, including the $288 million acquisition of payment company DPO Group by Dubai-based Network International in July, and the $500 million acquisition of remittances firm Sendwave by World Remit in August, suggesting that investors retain faith in the longer-term potential of compelling Africa-focused companies. China is Gabon's leading trade partner for a decade. China is Gabon's biggest trading partner, according to data published by the International Trade Center, a body that compiles trade statistics around the world. Based on mirrored data provided by partners on foreign trade, Gabon has achieved a cumulative trade surplus of $16.3 million between 2009 and 2020. This represents almost 30% of the country's trade surplus over the period. China has increased its purchase of products from Gabon at an estimated annual rate of 44%, thus becoming the buyer of 63% of the products sold by this country on the world market in 2019. 74.8% of the products sold during this reference year consist of hydrocarbons. This is followed by wood and other products. Also on the list is the United States, Gabon's second most profitable partner, with a surplus of around $11 billion between 2009 and 2020. Also in the top 10 are countries such as Japan, Australia, India, Spain, South Korea, Malaysia, Italy, and a surprising third place for Trinidad and Tobago, with a trade surplus of $9 billion over the period. France, the country's former colonial ruler, does not appear in this listing. There you have it, guys. Make sure you click on the subscribe button right now, and also click on the notification bell so that each time we upload a new video, you will be the first to know. Thank you so much for watching, and I'll see you in my next video. Bye bye.